I welcome Mr. Ujwal, CA Ujwal. Not only he's a guest here, he's also my professional brother, being a CA myself. I'll hand over to Vinodji for formal introduction of Ujwal, and then we'll get started. Uh, Vinodji, we may have to wait for a couple of more minutes so that more people could join. I think people are still joining.
Okay. Yeah, we'll wait for 2-3 minutes more.
Ujwalji, where are you based out of?
They're based at Navi Mumbai, Vashi.
Okay. And you specialize in the field of business valuation, or you have any other specialization?
Yeah, my valuation subject which I deal is more to do with the strategic valuations, not the one which are done for compliance purpose.
Correct.
Especially valuations which are used for negotiations and justifying our valuations to companies. That's where we are actually involved in. So it's more of a strategic valuations, which ultimately settles down based on certain negotiations, and then the final formal valuations are done by valuers.
So I'm sure you'll be covering some best practices and what is required to have the balance sheet ready for the purpose of business valuation. I hope you're covering these aspects as well.
Certainly, Chief. My entire presentation is purely from owner's perspective, how he should look into his own financials or his own operations. What does valuation means from owner's point of view, and how do we take it forward? And when we do routine operations, what factors we should keep in mind so that it can be maintained at certain value, or we reach to certain milestones.
That's very encouraging to hear, actually.
Thank you, Chief. This will not be theoretical discussion. It will be more of real life scenarios, practical situations, and how valuations are derived, including some very abstract businesses.
So how do you prefer Q&A? You prefer at the end, or if someone has a question in between, can he jump in? How do you prefer?
I'm fine with both the options. If people are okay, I'm ready to take it in between, and people can ask me at the end is fine, because if somebody is asking, other might feel it a little left. I mean, there could be some disturbance for that. I'm okay for both the options.
So just keep an eye on the chat box. There could be some questions coming in the chat box for you.
Yeah, sir, can you help me while doing this, because I might be completely focused on this. Prashantji, if you can help me, if you find some interesting questions, you can also raise it. I'm fine to take that way. Is that fine?
Sure, I'll help you there.
Yeah.
And in case you have a colleague of yours, in this window, maybe he can help you there as well.
I'll tell Matt. But he will with me.
Because I would be more concentrating on asking questions.
Nice to know this. It's going to be interesting then.
I'm a chartered accountant myself.
You said professional colleague.
Yeah, I'm not into, I mean, I'm still into practice, but not very actively nowadays. I'm more looking into this, the cyber security business we are part of. And in ISODA, I'm here in my capacity as a member also, and as the chairperson of ISODA.
Okay.
I think we can start, Prashant and Ujwal.
Yes, yes.
Yeah, we are fine.
Good afternoon, everyone. Today it's my pleasure as well as privilege to introduce Ujwal to all of you. Ujwal is a seasoned chartered accountant and a certified information systems auditor. He also has completed his courses on international standards on auditing and international financial reporting standards. He has more than 2.5 years of decades of experience. Right now, he's one of the senior partners with a firm called EA Patil and Associates. Before that, he was also associated with one of the big four consulting firms. At EA Patil, he is working very closely with clients to help them grow strategically, help them in internal audits, as well as with mergers and acquisitions. Today with us, he will throw some light on how we can improve valuation per se of our company, the process of valuation, and move towards a SME or public listing. Thank you, Ujwal, for joining us, and over to you.
Thank you, Chief. I thank Infotech Software Dealers Association for giving me this opportunity. I thank Vinodji and Prashantji specifically for giving me this opportunity to talk to everyone. See, what I'm discussing today is more of a practical methodology, which is how a business owner or head of business should keep in mind when it comes to valuation. What does valuation means from the owner's perspective? I'm not dwelling more into theoretical aspects. I'm focusing more on real life scenarios. So you being owners, you can understand this very well. You can very well navigate your company to the next level. My challenge is, in case if anybody don't understand, it's my failure. So I'm going to go down to the level where owner has to understand. Since you run your companies, you know your business. That's enough. That's more than sufficient for me to have understanding and take this forward. With this, I'll start with contents which I'm going to cover today. Are just hold on, my screen is not moving. Yeah. Today I'm going to discuss about origin of valuation and logic behind it. How did this entire valuation funda started, and what investors look into the company. We represent various funding companies, so we sit on their behalf on the valuations and negotiations, and we review companies, so I can share real life scenarios and insights. Methods of valuation. This method of valuation, and typically I'm dealing with the practical aspects. How do you understand your valuation, and how do you can take care of your company valuation when you do your business routine business? That will be my focus. And the next aspect is, how do we value new age companies? We of late we have been hearing about companies who have been making losses continuously, whereas when it comes to listing, or they make a huge valuation and they're able to list, be it Zomato or companies to similar space. Let us understand how this entire concept works and how does it help. And the last aspect is care you need to take for good valuation. How do you create your own company's valuation? I'll give you some tips and some guidance based on my past experience so that you can have this done. So when we start valuations, when we say valuing business, it's not a completely science. So if you ask two people to value your company, you might find figures are different. So then what is a valuation? Why there's so much discussion about valuation? Valuation is a combination of science and art both. So we'll come to know how does it works when I take it discussion forward. So a brief of valuation, how this entire concept originates. If you look at valuations, generally we all have valuation, and we all misunderstand valuation as a net worth. And whenever I've gone for valuations, or whenever we discuss valuation, people give me their financial statement and they tell me, boss, can you help me out based on my financials? But let me help and explain everyone, your balance sheet is not the one which completely indicates your valuation. Your financials are just beginning of your valuation. It's just beginning point of your valuation. The real valuation is is in operations, where you guys being owners are actually involved in, you have that understanding about. So a lot of insight, a lot of information is already available with you. It has to be put in a specific shape so that you can identify that and you can evaluate. It's when we do valuations, these are just not numbers. There's a number against those numbers. There's a story behind it, or for stories supported by numbers. How will I grow my business in future? What will be those numbers? How will I arrive those numbers? What is my basis of what are my assumptions for determining those valuations? All that plays a key role. So there's a big story in every valuation, but each story also has a financial figures inside in it. So that's how it works. And when owners, the way they conduct the business, there are different business combinations, arrangements, because of which there could be complications. It looks like a complications in the valuation. The valuations might look complicated, but when you see from the owner's perspective and they have their logic why we do business in a specific manner, you will certainly understand. And each valuations, sometimes these valuations are, since I told you in the beginning, these are art as well as science. That means they carry inherent risk inside. So these inherent risk is figures can change in future. If figures change in future, you can't say my earlier valuation was wrong, because circumstances, business conditions change. So based on that, figures can be different. So these understanding people have it when they invest in companies. They have this understanding when they say what is the value of a company. So this is very important for us to do it. We generally, when I talk to owners, they always come out with their own figures. Ujwal, my business should have value of at least 50 crores or 150 crores, 200 crores. So they have their own rough number. I've seen it. These numbers are sometimes purely based on their needs, their personal needs, their personal requirement. Mera itna loan hai, mera itna payment hai. So based on that, my valuation should be X, Y, Z. This is how they try to do it. So their personal requirements, their personal obligations, they are attached to the business, and then people try to value the company. That's very important. Number two, when people have to do valuation, they should have a very fair degree of assessing a future risk. In the sense, when I say I'm going to grow my business, they should know what is the risk involved in it. They should also know how I'm going to achieve it and what happens in case if I don't achieve it. Understanding this is very important. These valuations sometimes they look like a complex, but of course when you understand through logic, it's not that complex. And of course, it plays very key role who's doing your valuation. Now, when I say valuation, a lot of owners tell me, I want to understand my business value. But when we ask, what is the purpose of your valuation? They said, nahin, mujhe mera value samajhna. It's not like this. The valuation concept varies depending on who's coming and sitting on table or whom you're telling your value. I'll give you an example. Now, I want to sell this bottle of water. I'm selling it in a Mumbai in the month of June, July, when it's raining heavily. There's hardly any value to it because water is available. If I sell same water in Rajasthan, hot desert, and the value of this water is very different. So what is important? Who's buying this? So it's very critical for us to understand what is the value. And when we say value, it depends on what a buyer is convinced to buy. So each buyer has a different risk-taking appetite. At the same time, each person or who wants to invest, need not be buyer, has a different reason of buying your company. Depending on that, his valuation can change. So valuation is not something static. It cannot be, I cannot say a valuation, I'll use it for understanding my own business purpose. Same, I'll use it to offer to investors. My value might be multifold more when I go to investors, depending on who's coming on sitting on my table. So it's very important when we do valuation. Again, one very important point I want to touch upon everyone's. When we see value, we always see value as value of my business. No, your value of your business also depends on with whom you shake your hands. I'll give an example. I am joining, I'm shaking hand with a company because of which the other company's valuation is going to go up. So if their valuation is going up because they are tying up with me or they're taking stake in me, my valuation is getting generated there. So do not use my financial statement as for valuation. This is how we discuss. So I'll take you through some of such examples when we go through valuations, and then we take it forward. And So what is the fair value? Now let's understand what is the value. We'll talk a little bit theoretical, but it's important for us to understand what is a value when we see. So there's always a discussion about what is a value, what is pricing. Let us understand what is a fair value before we get into it. Fair value is what we understand is an asset where people are willing to exchange. An asset could be your business, where there's a willing buyer and the willing seller, and there's a knowledgeable person who's selling it. In the sense, if I'm selling you, I know what is the value of this water. In the sense, I know what I'm selling you. I'm selling you this as a water, whereas this is drinkable water. Whereas if it is not a drinkable water, but that means what my belief is different and what I'm selling is different. No, it doesn't work that way. So the person who's selling should know what he's selling. He is selling it as it is. So if I'm selling a rotten egg, I'm telling you beforehand, this is an egg I'm going to sell, which is not in a good condition. This is how it should be. And the buyer should also know what he's buying it from the person, and he knows what he's buying it. So what does this mean? You need to understand what we are buying it. You need to understand where we are investing it. That's very important for us. So there has to be willing and knowledgeable buyer. There has to be willing and knowledgeable seller. So these transactions should be done at arm's length price. In the sense, these are done as if you guys are not related, as if you guys have no connection with each other. What you would have paid it in the market. So one guy says, if I pay 10 rupees, another guy says 12, the third guy says, I'm paying 15 rupees. So there's some range you get it between 10 to 15. What does this indicate? It indicates your value. The value could be range. What I'm trying to tell you, value can also means range, need not be one specific figure. Depending on certain circumstances, these ranges can be used. So what we understand is price is what you pay. That is what said by Warren Buffett, but value is what you actually get it.
So can we say, sorry, Ujwal,
coming
in between. So can we say that valuation here means that value perceived by your prospective investor, buyer, something like that? Can it be
absolutely correct?
Perceived value?
Absolutely correct. And we need to convince them what value they see it on us. Let me give a real
change someone's perception as to the asset or the business we've been running or we are putting up for sale.
I'll give you one example. I was given recently, we finished one assignment. Assignment got completely done. In which company was a loss-making company. Assignment was given to me to close down that business. Investor had already burned his money, and then he was frustrated, so he asked me to close company. When I met promoters, I realized they have sold their lock, stock, barrel. Their even houses are mortgaged. They have sold everything to create that product, and the company is still in loss, because every time they have come out with the product, there has been a new product in the market. There has always been a competition. While discussing with them about closure, I wanted to understand what was the philosophy of investment. I realized this is a very unique product. And even, in fact, they told me this product doesn't exist with major leading telecom companies in India. So I spoke to the investor who had asked me to close down this company. I requested him, give me 3-4 months time. In case if it doesn't work, allow me to help me to close this. So we went back to leading telecom companies, including Bharti Airtel. We went to Reliance. We spoke to Voda. And when I was talking to Bharti, certainly they said, boss, company is a loss-making company. We don't see any value in it. So what our argument was, by taking over this, you will have in your portfolio one service which doesn't exist with other telecom companies. And how will it impact overall your market position in that? How will you generate money from that? Based off that, you have to pay me some portion of it. With a lot of negotiation, the company which was about to get closed, we could manage to close the deal at very handsome price. And that's how it went. So this is an example where my value sits somewhere else. So if I'm able to prove in isolation, I might not be making money, but my value, when I get attached to somebody, I can increase that company's value at much higher pace. It's like I'm a standalone engine, but if I'm getting attached to some car, I can push their speed at much higher speed, although they have jet engines available. So
yeah. You can help members, the organizations, the participants here to have these these perceived values enhanced or make them understand from the buyer's perspective, like you were able to change the perceived value to Airtel, for example.
Yeah.
So this is something which you regularly offer as part of your services?
Prashantji, it depends on who's coming on table. It's very important for me to understand who's coming on table. As I told you before, it depends on buyer. I have to target my valuation, my perceived value. So if you have zeroed down on certain targets and those teams are in talking terms with you, or they are already in discussion level, certainly I can get into it. Or before that, I can help you to simulate situation and understand how you should evaluate your value of a company under various circumstances. We can take that as one of the option, and we can do it. But we cannot determine any value because there's no target company sitting across the table.
Obviously. Please continue. Thank you.
So next, I want to deal with some what investors looks into company. Let's assume each one of you is taking investment. You want to either go for public issue or you want to go for private equity before going to public issue. Both the options are fine according to me. But what do these investors look into your company? What are non-financial factors and what are financial factors? They see it in company. It's just not a financial profit and loss always seen. There are various other factors. I want to share some of those factors. It's very important, and it's very important for each one of you to understand and take care of your personal information.
Ujwalji, there is a hand raised by Mr. Hari Krishna.
Yeah, Harishji, yes.
Yeah, good evening. The question is, you said the valuation is based on the perception or the value that you create.
Yeah.
Which is heartening to know. But most often, while you have a vision, while you have a business model, while you have a go-to-market, most often people I'm told that people look at a basic formula, which is a multiplier of either the PAT or an EBITDA based on the kind of nature of the business. So how is it? Is it the perception? Is it the business model, the vision? Or is it straightforward multiplication of the health of the business?
Harish, I really appreciate. Thank you for this question. It's a nice question. I want to certainly answer this. When I'll take models of valuations, I'm going to take those that will come to that. What is multiple of EBITDA or multiple of your turnover sometimes is some kind of a thumb rule which is getting created in the market based on various deals which have happened. That is the factor which is used as. But if you refer all the books, there is no book which says multiple of EBITDA for a pharma company, for IT companies, 12 times or 10 times. There is no such methodology available. There's no such formal. This is for understanding from owner's perspective, what is the multiple I'm getting it of my EBITDA, or what is the multiple of my turnover I'm getting it. It's for his understanding. So, but if you generally look from the owner's perspective or investor's perspective, what he looks into it is a payback period. What is the return on investment within the time I'm going to recover it, or is going to strategically help me out in my business. So we'll talk about these type of investors, and we'll also talk about this methodology valuations, which are used formally and which are used informally as well. Harish, is that fine?
Yeah, thanks. It answers. Let me wait for the
Yeah. So what is important is non-financial factors. When we look into investment in any company, or either stake dilution or partial or fully, what we see is their people and their background. So what is important, if I'm expecting owner to continue with me for longer period, or team to continue with me for long period, or if I want to see what is the health of company presently, of course, the health of owner or his background, in the sense his the way of handling business plays a very key role in the business. If you remember in .com era, the investment was done on the concepts, and the second preference was given to people. Those failed. Whereas in present recent times, if you see in last 7-8 years onward back, if you see the investment, it's always seen who's the person who's running business. His credibility is extremely important. So if somebody has some rating which is not so good, certainly impacts. So each one of you are requested to take care of your background, take care of your entire image, financial image or financial factors, so that this should not become a hurdle. Business and concepts I just explained you. Way of doing business is very important, because if I'm investing in your company, I would like to see my money safe. I would like to see is company's compliance. It doesn't get into any challenges. So money is where I'm putting it, has to be safe. So even if there is a genuine business loss, it's fine to me sometimes. But what is important is it should be safe. So business valuation is not always about it's a real estate. So again, this people understand when we talk about valuation, they always tell me my value of my land is this much, my value of building is this much, so I should get this much. So that's not how it works. Business valuation is not is something different. Of course, we do take into account factor of real estate, but we value business first separately, and then we value real estate separately. It depends on certain circumstances. We have also had a couple of deals where the investor was not very keen in the real estate, so we had to restructure, take these assets out, and the business was available for takeover or partial dilution. That's how it goes. So it's the real estate valuation is not a valuation for a business. What is important is investors' risk appetite is very important. That means who's coming on tables. I want to share some example here. Now I have two. Generally, we classify investors into two. One is financial investor. One is strategic investors. Financial investors are those other investors. They want to invest money in your company. They want to grow their investment, and they want to exit. So it's very clear understanding how they want to exit. The whole purpose of they coming into your company, taking partial or full stake, is they want to make money multiply on the investment. So their interest is that investment should multiply. That's how they look into it, that they are financial investors. Whereas if you look at strategic investors, are those investors, they want to, for example, a company in US wants to get a foothold in India. They want to expand their business in India. So they want some local partner to get aligned to them so that they can save their time, they can get directly to market easily, much better way. And also the local partner can also help them to source some material from India. In those cases, they are strategic partners. They're not looking to multiply investment. They're looking to multiply their parent company investment by facilitating, by using the investment, where the investment has been made. So this is very important for us to understand who's coming on table. So it's important if he's a multinational company which is looking for a foothold in India, they may not see sometimes your profitability. They see your intellectual properties. What are those intellectual properties? Your intellectual property can be your business relationship. Now your entire organization is a software dealers association. What does this indicate? Each one of you have intellectual property of customer relationships. Each one of you have a customer relationships of 10 years, 15 years, 18 years, 20 years. More longer the period, the high value of the intellectual property. So if I'm an enterprise software, I want to get into India, and you are into similar space before, and you are available, and I think I can leverage this my product, because I'm in, say, logistics software. You have some other enterprise thing. You can very well he can come to you. He may not see your balance sheet. What is he looking into it? He is looking into your intellectual value. What is your intellectual value? Your relationship is a value. How do you value that? Is a different factor. But what is important, you have to understand, is where does your value sit? Your value sits in your relationship in this case. There are companies who have been developing routine research for clients. While doing that, they are able to create their own intellectual property. So the value sits there. I want to share one example of a company. They used to take certain clinical approvals or drug approvals for various countries for their pharma products. This expense was charged off in P&L account. We identified that we accounted as intellectual property. When I did that, I was struggling to get those, because a lot of those were very old. When we went for stake dilution, the other company valued these approvals of different countries at very high price. I'll give you one example. Some 68,000 rupees invested in one of the country, which that is a value which we could identify from the books and we could account, got valued for more than 1 crore. So what is important for the strategic investor? What is important? He was looking for having a company with specific approval so that he saves his time. He saves his entire efforts. So that's how they look into value. The value is getting enhanced when you look at your intellectual property. That's how it works. And The movement of working capital plays very key role. You all, being a business owners, you understand how this does your movement of working capital generates. The more circulation of your money generates a higher profits. In the sense, your margin might be 2%, 3%, 4% sometimes, but the more you circulate, more order you circulate, it generates more money. Yes, it can be called as a financial factor also. It's appearing in non-financial, that's fine. But I just wanted to share this. Let's understand some non-financial factors as well. What those are. Keys: return on investment, typically, which is a direct approach, which is used by certainly financial investors heavily into their analysis. Of course, I'm not saying the strategic investors don't use it. They see it in form of an efficiency, what we gain out of this Indian enterprise. How can Indian enterprise can add value? That's how they see their investment return on investment. Then another approach is financial factor is, what if instead of investing in your company, what if I have to start my own software distribution company in India? Let's assume I want to start distribution company in India, hire the best staff, try to get relationship back. What you guys have done it in probably in 18, 20 years, they might, because of their money power, they might do it in 10 years. So what money they would have spent in 10 years is the value they would be ready to pay to you, because that's a value setting outside your business. That's how you can very well connect to it and you can take it. So value of setting up a business is certainly a factor which is taken into account. Efficiency to the main operations and contributions by target companies is, I told you earlier. So if it is a strategic investors, they see how do we derive efficiency for our parent company. There are a lot of research companies in Europe and US. They have some portion of research being done in India, and Indian team also helps their team, which is front ending in their research. So they're able to generate huge value from India. So that's how they see value. So value, again, when I see valuation, somebody has to invest in my company, is not my financial always. It depends on what you guys have created. If you have 15, 20, 25 years customer relationship or longer relationships, you have value. Or if you have extremely key clients, you have value. I'll give an example. One of my clients is a registered vendor with ISRO. To get that ISRO name, we paid huge money. By taking that ISRO, we being, after investing in that, we are ISRO company. And because of which my other products got much better leverage in the market. I'm giving an example. One company in US was registered with NASA. He's keen because getting that is important for us. So value is of your company. What somebody is willing to pay is also depends on how you generate a beneficial benefits to them based on your investment. Angel investors and promoters have a different approach. Most of us, we have seen it. Angel investors are the one, they are ready to help us, help with initial amount to promoters. I mean, there's a Shark Tank. We can see that in India is happening now, every nook and corner. But yes, initial angel investment has been a prevalent factor in India. If you remember, in earlier olden days, angel investor used to be our parents. We never took them as an investor, unfortunately. Had we treated their money as an investor when we started a business, yes, they are our angels. They are our angel investors. And then we have a commitment to return that money with certain multiplier factors, with certain interest factors, or whatever the cost of those funds, they are expected to get more. So angel investors are the one who contribute initially when things are at very conceptual level, or when they are at bootstrap level, when somebody is helping with those small sums, even sums like 10, 20, 50 lakhs, initial amounts become huge. Yes, these investments carry a lot of risk because this concept has to mature. You never know whether it will take off or not. But if it takes off, it does matters a lot. So initial investments are important. There could be a combination of factors. What I say, combination of these factors, financial, non-financial factors, they play a very key role. And based on that, we do it. So as I told you, accounting, financials are just beginning. So financial factors are just beginning, whereas what you do business in day to day, what you have created intellectual property, which probably you may not realize it as an intellectual property, is a value where it sits in. That's how we entirely value company. Sorry. Now, let's take an example of how again valuation influences. Now there's a company, say somebody in your ISDA is good at marketing. They know how to sell software. They have very good customer relationship. They understand customers' business, so they have a lot of research about customer, what customer needs. You know it very well. Whereas you also have, but I mean, you may not have development center or an assembly center for certain things. So if you have to acquire a company, IT company or a development center, which will give you a 360 approach, all the dots are getting connected. It is helping you to have a better backward integration so that you can keep developing, keep changing softwares depending on customer needs. Yes, then it is of course a different business, but the value of what you can generate in market by adding to your portfolio development center can be a value, has to be given to that, can be used as a negotiation value. I'm just giving example. In contracting engineering businesses, there's an EPC contracting which says engineering, procurement, and construction. A lot of these contractors do not have engineering sections; they outsource these engineering activities. So, if you, in the sense now, when you're developing a bridge, the contractor himself has to decide what kind of engineering design has to be there. So, this engineering design is within the four corners of protocols which are set by department. So, they have opportunity to design the entire engineering and procure and execute. While if you have this a very good engineering team within your portfolio, you can very well bring down your cost. You can get a higher margins. So if a contracting company has to acquire engineering, engineering adds a lot of value. Because of engineering company, they become eligible to bid for higher contracts, bid for higher projects, bid for different EPC contracts. So their value sits, a lot of value sits in this engineering company. That's where the engineering company can have its valuation. So let's take example of various formal methods. I'm taking, I think Harish wanted to have on this. I'll tell you how these valuations work. I'm not taking you a very theoretical portion. I want you to understand how these concepts work. When you look at valuations, there are three ways of valuation, broad ways of valuation, or combination of three ways of valuation. One is the traditional method of valuation we call historical approach, which is based on the asset-based approach. These are typically asset-heavy companies, and each of these assets are not directly revenue generating, but those are part of the portfolio. For example, builder is constructing property and he's accumulated some unsold property. Yes, there's an asset-based inside. Yes, so this is how it works. But yes, asset-based approach has been a traditional approach. We'll see some examples today, how these valuations are done and how do we do it. There's another approach is market-based approach. How do you perceive your value through somebody else in the market? We'll discuss that. And third is income-based approach, in which we use discounted cash flows and other methods. We'll discuss each of these. Today, I'm discussing from the owner's perspective. I want you to understand these concepts. I may not expect you to deep dive into it, but you should know how to use this concept, how to evaluate your own business using this concept. That's what I'm trying to help you out today. That's my objective of today's discussion. So, sorry. So combinations are sometimes used. So we'll see this now. Let's take one by one. Okay. So broadly, I've already explained you what these methods. Okay, I'll just go. First approach, what we discussed is asset-based approach. I told you first is asset-based approach. Those are traditional. What does asset-based approach means? I'll try to make example very simple so that all the methods we can use same example and we can understand. Each one of us, we understand what if I construct my own house, isn't it? If I have to ask you what is the value of construction, so you can very well tell me, there's a land price, there's a brick price, there's a steel, cement, engineering cost, approvals. I know what is my cost. So what is that price? This is a typical historical method of valuation where you actually see what asset is getting deployed, value at which you have purchased, and then you value your asset, isn't it? So these are asset-based approach valuation. How do we do this asset-based valuation? We use your balance sheet and see what money balance sheet indicates, how much you spend on that asset development or business development. And how does it get reflected in your financial statement? I have a small balance sheet figure. I'll show you that. So I think we can take that. So this is how you try to value your generally business. What if I make or construct is my approach, and my it's purely an asset based approach. We do it. It need not be the realistic value, but in this also you have two examples. Ujwal sir, I've made my house. I've spent a land, building, construction, civil, everything. I've spent 1.5 crores. This is one way of valuing. But another way of seeing valuation. So I've made my house, but my house, if I buy this in the market, and my neighboring plot got sold for 2 crores. So there's a relative price. So what is the value for you? If I use traditional approach of valuation, which is asset-based valuation, I'm giving an example of T-shaped balance sheet. It's typically just to help everyone understand. I think it should move this. It's disturbing me. Yeah. Now, if you look at your balance sheet, each one of you have your own balance sheet. You guys are running your business. You understand your balance sheet much better. I've given you T-shaped balance sheet just to make it more life simple. Now, this company shows plant and machinery, building. They have some investments. They have receivables. They have fixed deposit, cash and bank balance. Against that, they have payables for there's an advance from customer, suppliers payment is pending. There's a secured and unsecured loan. If I take this entire thing, what is left out in the company is capital plus reserve, how much you've invested till date in the company plus your accumulated profits. So if I use traditional way of valuing a company, your value shows 4.85 crores. Another flip side to is if I do this valuation using a revaluation method where you're saying, no, sir, my value of my plant and machinery has come down because this is a depreciable asset, whereas my building has gone up because the prices of building have gone up. My listed company shares have gone up, whereas my private company investment, which I've done, has gone down. So based on that, if I do valuation, the valuation, same company balance sheet can be 5.75 crores. So traditional approach has two methods. One is using historical cost method. One is revaluation asset method. So this is one simplest way of valuation, which initially we had it in the beginning. Later on, we went into different combinations. We'll see those when we go to the next level. So what is now, let's take a little more. Now I'm saying there's a next door approach. So I've made my house, I've spent 1.5 crores. Whereas next door property, similar property, it got sold for 2.5 crores. So what we do in such circumstances, in the sense what I'm doing, I'm comparing my company versus his company or my property versus his property. Then I realized, okay, he's got an additional balcony, which I didn't have. Okay, what is the approximate cost of balcony? We reduce. But I have a good lawn, which he didn't have. So I'll add value to that. So at that 2 crore, I'm reducing for balcony. I'm adding it for my lawn. What I'm doing in this, I'm doing an adjustment. What does this adjustment is indicating to you? This adjustment is making two things are comparable. One is purely taken based on market value, what market perceives. This is a deal which is done by him, that neighboring property owner, to a guy who's not his relative. It's a fair deal, and that there are some changes in that property, in my property. I'm making those changes. He's not even painted his house. It's got sold for 2 crores. Whereas I've painted, I've put the best of India's paint, which is tractor, whatever, and it is giving me better. So that adjustment, you need to do it. So those adjustments play very key important. So what you do, company valuation. When you compare, if you're using a methodology, market-based approach, which we call price earning approach, PE approach. A lot of time you must have heard this word from investors. What is a PE? What does it indicate? What is the value market will pay? Or what is a per 1 rupee profit if I generate? What market will pay? Now, I want to help. I'll help you to each one of you to understand. Identify each one of you a company which is very close to you, very close to the way you do business in the market, which is listed on stock exchange. In entire all dealers, everybody, there are companies, for example, their turnover is up to say 100 crore. There are companies up to 500 crore, 100 to 500 crore, or 500 to 800 crore into the similar space. Try to identify a company which is into similar segment. Now let's assume your company's turnover say 300 crores, and you find a company which is similar to you, selling similar products, but is of a different company software, that their turnover is around 400 crores. They're similar to us. The structure is also similar. Okay, that is a comparable figure. Okay, then what you do is, then you see what if they generate 1 rupee of profit, what value of market share price is there. In the sense, if they're able to get 1 rupee extra share price, what is how the market is reacting to it? What is the value it goes up? Their profit, for example, today they earn on an average per share is around 10 rupees. How do I determine this? Entire net profit divided by number of shares. So I'm getting per share price, so value per share, earning per share, profit divided by number of shares. So I'm getting profit per share. Now compare that companies. If their company's profit per share is say 10 rupees, whereas the market value is 50 rupees, and your profit per share rupees is say 20. So what would be your value? You can very well compare that. Are you guys with me? If anybody has any question, I'm ready to take this. I want you to understand this. Being owner, you should compare yourself with others. So what is one of the best factors, what we take it is price earning ratio, we call it. So you're comparing your house with somebody else's house, you're making adjustment, you see, वो मेरा है. If I'm saying my 500,000 square feet का मेरा घर है, वो 800 का है, I'm making an adjustment, but they are comparable. I cannot compare 1,000 square feet flat or a property to 500 because they are totally different. The kind of segment is different. The kind of people who come and stay different. Of course, each one of that has a value, isn't it? Why we pay more price for a flat? Because we want certain kind of neighbors, certain segment of people staying there, isn't it? So this is how the pricing gets influenced. It is not the value of brick mortar and what steel which is used for constructing, isn't it? So the value gets influenced by these factors. And how do we derive this? Compare the best, which is very close to you. Make certain adjustments for making it more comparable. How do we do these adjustments? You need somebody who's a very mature to do this. There you might need little help of professionals, or even if you apply your own brain, being in business, you can very well do it. A builder can tell you having an additional balcony and not having additional balcony, what is the price? How the market reacts. He can very well tell you. Giving 3 parking versus 2 parking, he can very well tell you. Same logic applies here. You can use same logic to value a company with somebody. So you can use this as a basis. I want each one of you to start working on this. This will help you to understand what will happen if you go to the market. But exactly now, let's assume I'm comparing a company which shows if they earn 10 rupees, their market value is 50 rupees. Does that mean if I earn 10 rupees, my market value is 50 rupees? May not be, because the major adjustment we need to do is they are listed on stock exchange. In the sense, if anybody is investing money in their company, he can very well exit. He can very well walk out of the company. He knows whenever to make money, he can make. Where in case he invests in your company, he cannot. So the value cannot be 50 rupees. The value has to be reduced there. So those adjustments have to be done. But at least you can derive some figure. You can give some basis of your own figure. So this is how we use price earning methods of valuation. I hope everybody is with me and everybody is able to follow it, what I've said so far. If you find anywhere I'm fast, I'll slow down. I'll give you more examples, more ground based examples so that we can easily come to this. Now, third is, let's take example of same flat. The one way of comparing my constructed property, my bungalow could be what money I've spent inside making it, or what if I buy it, another, or volume. Second approach, what we've seen is the market approach, which we call a P approach. At what price this will get sold in the market, depending on others' transactions, where people have already done transactions. Let's apply third logic. What if my objective is not to sell this house? I want to give this house or put it on rent for the next 30 years, throughout its life. I'm assuming life of a property is 30 years. What does this mean? That means value of this house is a value which it will generate during its lifetime, isn't it? What is its lifetime? Life of that asset. What is life of that asset? If engineering guy says 30 years, 30 years. If he says 50 years, 50 years. Okay, so 50 years ke baad, matlab every year it will pay me 1 lakh rupees rental, but there's also inflation factor. 1 lakh become 1 lakh 5,000, 1 lakh 10,000. We'll start charging more rentals in future, but this is how it will go. But what will happen? The entire accumulated, is that my value? Yes, it is your value, but small change you need to understand. If you earn today 1 lakh, and if you earn 1 lakh after, say, the end of an asset after 30 years, the 1 lakh what can buy today in the market may not buy same level of quantity of things after 30 years. So today I'm assuming today by 1 lakh, I can buy certain things in market or certain facilities in the market. After 30 years, I cannot. So what does this indicate? There's a deflation, there's an inflation which impacting your money. So what do you do this? The entire 30 years rent, you're trying to discount and you see what is the value today. अगर 1 लाख आज मिलता है और 1 लाख करके मुझे 30 साल के बाद भी 1 लाख मिलने वाला है या 1 का 50 लाख हो जाएगा, जो भी मिलने वाला है, उसका what is the value today? How do I know that value? I need to discount that value today. The entire value is added and the discount is determined. That is called discounted cash flow. I'm trying to make it simplest from the owner's perspective. This is how we have to understand what is discounted cash flow, what my business can generate in the next 2 years, 5 years, 10 years. Now, there's always a debate. So you can very well give and get away with giving an example of a property which can be estimated 12 years, 30 years, 50 years. How do you expect me to value of my life of my business? Yes, it's a good question. It's a difficult question. We don't know how long it will last, how long it will go, what is the impact of regulatory changes, what is the impact of new softwares coming in market, what is the impact of competition, what will happen if somebody will come and buy, what will happen if some India invades or somebody invades us, what will happen to that? We have no certainty. So what is done? How do you do valuation in such circumstances? It's a very good, tricky questions. Very tricky question. In such case, we need to understand what is a probable period I can take it. Generally, people take 3 years, 5 years. Beyond that, it's difficult. But there are cases. I'll give you example. I have engineering company which has certain projects. If I add life of these, one project takes 3 years, one is taking 3.5 years, one project takes 6 years to complete. So my life of an entire company, depending on the orders I have, it can go up to 8 years, depending on all the orders I have. I'm going to add all the orders and determine the life of my asset and do it. So now what will happen? We sell in software and infotech. We buy it and sell it. The key gets directly downloaded. We may not even physically do it. How do you determine mine? Yes, it's a challenge. It's a challenge. Those circumstances, how does the investor look at it? Now, again, I told you, my value means how the investor is, what he perceives my value. How investor looks at me. If he is investing in me, how long he can do business, confirmed in manner, or what is his business plan? If his business plan is only for 3 years, he would like to see your discounted cash flow for 3 years. Although I'm making it for 5 years, I'm saying my business is 5 years. Going to survive because there's no justification we do it 5 years, but these become over the period of time. Thumb rule, over the period of time, there is a fair amount of certainty. At least if you say what you commit today will happen in 5 years, and this certainty commitment, why we are assuming and taking it, because we have seen it in past. You've survived for 10 years, 15 years, so it is very fair for us to assume 5 years. But you can sometimes say, no, my life is 8 years, 10 years. You need to justify why you want to take it 8 years. Now I've survived for 18 years. That means I'm going to do it. It's a yes, that can be point, but a guy has to accept. But you can also say, okay, I have a contract which says parent company will not appoint any other distributor in India other than me for next 10 years. So I have life for 10 years. Yes, that could be a basis of justice. You need to justify using those basis parameters. And it depends on case to case, depends on each company to company, depends on who's coming on table again. Fine. So this is very important. So what we do in discounted cash flow, what we call a discounted cash flow, is nothing but what I'm trying to find out how much money I'm going to make it in future and what is its value today. This is how I do it. And we do take into account discount and inflation. I just want to help everyone to understand inflation is very important factor for all of you. And if you guys have done a turnover of say 100 crores, and if you have earned a profit of say 2 crores, this year, and next year also you have turnover is around close to 100 crores, and you have earned again a profit of 1.98 crores or 2 crores or 2 lakhs. Generally, we say I'm more or less in the same range. I'm still in the same level what I was previous year. No, because what money could buy previous year, money cannot buy next year. So what it could buy more last year cannot buy that level of quantity next year. So the value of money is going down. That means if you see any company which is at a stagnated level, that means this company is not growing. It is degrowing it. That's how we see it from the investment point of view. That's how you should see your business as well. If your business has not grown, so beyond a certain amount, then it is a challenge. Let's take an example. Our consumer goods index could be 4%, 5%, 6%. That means every material or things what we use in India is going to grow up, our value is going to go up by 6%. If I made profit last year 2 crores, if I'm making profit this year 2 crores, no, that means I've not grown because this year my cost of living or cost of inflation is 6%. So 2 crores is not the right figure, isn't it? So it's important for each one of you to understand. When you look at your financials, please make sure that your focus should not be just numbers. Look at from the inflation perspective as well. Try to understand that. So you have to at least make a thumb rule. What is my inflation? If inflation of India is 6%, if I grow 8%, that means I'm growing by 2%. My number can go up, my number can look big, but what I'm making is only 2% growth by doing 8% growth. So this is how you should evaluate company. This is important for you because same way investor look at it. And mind well, each one of you are investors of your company. Your company is different, you guys are different. Your company has a liability to pay your money back. That's why your investment, your capital sits on the liability side of your balance sheet. If you do not behave like an investor to your own company, don't expect somebody else to come and invest. You have to ask similar questions to your system, to your own internal governing body. If you would have invested this money, just assume if somebody invests, you guys invest same level of money in somebody else's company. You would have 1,000 questions there. Why can't same questions be raised to your company when it's your own money? End of the day, money has no color, no matter whose money it is. It's very important for you to understand this. So please be in mind when you guys talk about valuation, you should see your own company as your first investment. You have to see that as your first investment and then talk about investing in somebody else's business or taking somebody else's money as a business, as an investment in your company. It's very important for you to understand. So this is we call discounted cash flow. I'm coming back to again subject. So it plays very important role when we do discounted cash flow. When I say capital, they could be borrowed, they could be own money. When we do valuation of business using discounted cash flow, all the liabilities, including outside loans, we reduce it, we remove it, and then we call it an enterprise value. This is how we do it. Okay. A lot of time non-operative fixes are sometime adjustment. Now somebody tells me, sir, I have a company which gives me 5 years. This is what cash I'm going to generate. Great. But that has an office. That company, he has a software company, is sitting in an office which is on Nariman Point. Now when I look, and then he's paying he's invested huge money to buy that office. Now, if I have to invest in this company, what I want to check first is whether that office is necessary for this company. Do we justify that investment in the company? If I sit outside that office, do I still sell my software? My business does not need an office. What it needs is a good product. What it needs is a good team to sell it, deliver it, and take care of client needs. So what do I do with that office? As an investment, if I have to invest in that company, I'll say, I don't need that office, boss, keep it. Aapko bahut important kharcha hai, rakh lo. I'm not a real estate company. I'm keen in investing in your software company, for software dealers company, isn't it? So this is how it works out. So you have to understand when you do valuation, discounted cash flow also, we do have a lot of arguments there. I do not want to take care of these assets because they don't generate assets. They don't generate any cash. So it's very important for such assets sometime to be taken out. A lot of time in deal, I've said to my investor, don't buy this asset. So what we do is we buy company minus that asset. How is that done? We need to restructure company before we buy it. Of course, we make a commitment in writing and then the entire restructuring starts. And that's how the acquisition happens. It's very important for all of us to understand this. So each one of you, if you are treating your own company as an investment, understand, read your own assets, find out what assets are generating income, what assets are not generating income. Now, again, when I generate cash flow, you make a discounted cash flow. You're always assuming my business is going to generate cash flow. Now, as an investor, I can always see from two, three different approaches. One is optimistic calculations. One is pessimistic calculation. One could be moderate or medium average calculation. I can use these evaluations when I do business. So these discounted cash flows are played on paper before we take a call. We understand what worst can happen, what best can happen. What if this company doesn't sell? What will come to me? What will happen to my money? What liability do I have to pay? Or how will it function if I make a good money or a moderate money? Can it function still? Can it work better? It's very important for us to understand. Again, earlier I told you I'm assuming life of my assets, say 5 years. Does that my company means company will not generate money after 5 years? No. There is a factor, we call it a terminal value. So I want each one of you to not to go down how that formula is derived. What is expected to you to understand is, one is when we do discounted cash flow, we determine value for those 5 years. Beyond 5 years, there's a calculation which says, what if this money, what I've generated in 5 years, if I continue to invest it in some certain specific assets, how much it will generate? That value is also captured. So there's a calculation, there's a theoretical approach given to it. So value of a company can be 25 crores plus terminal value can be 10 crores. That is how it becomes 35 crores. So it's not a value. So value is not for 5 years. So it is your business is assumed as a going concern. We take that period as a beyond 5 years and we value it. So that's how it's done. A lot of times we have other non-operating incomes, like we have fixed deposit, interest, some rental coming in the company. Those we don't want to value those. We don't want to take those. If I'm not very keen on acquiring those assets, we need to make adjustment, and that's how we'll do it. Harish was saying about EBITDA multiples. I just want to touch upon this now. When you do these valuations, now you've heard from me 3 ways of valuation. One is asset-based theoretical approach. Next is next door approach, which I call price earning approach. Market-based approach is also known as. Third is approach based on discounted cash flow. These are 3 combinations. Whenever we do these valuations, after that owner says, "Acha, mera value 50 crore hai, mera profit kitna hai? 5 crore hai. Okay, 20 times I'm getting it." This is how it is referred. So EBITDA multiples, net profit multiples are not the valuation. These are ways of understanding. Okay, if I'm generating today 10 crores, what I'm getting out of it. That's how owners understand. So that's how it becomes a way of norm of understanding. How investors understand what is my payback period. If I'm putting 50 crores in your company, what is the time period within which I'm getting? So what I'm trying to understand within which I can recover my investment. Same way, what from your perspective, your company's perspective, what you're trying to say, what if I generate 10 rupees, how much more I'll get to it? How much more in terms of multiples or in terms of multiple you're trying to understand. It can be, you can use a EBITDA as a basis, you can sometimes use even turnover as a basis. Where EBITDA should be used, where turnover can be used, is a way of understanding, owner's understanding. Certain businesses which are top line driven, they are more customer focused. Let's talk about companies like Big Bazaar. Their turnovers are massive, margins are low. The massive margins, massive turnover. They're top line driven. But what the margins they do it, margins are very small. So how does this EBITDA should get compared? Should it be on top line? Should it be on margin? Depends on who's investing. I told you before. Of course, depending on that, it gets influenced. But as a Big Bazaar, if they are seeing by every increase in turnover, if I'm going to get more value, somebody is ready to pay more. That other companies, as a Walmart, and they want more market capture. So they are more keen on market share. So they are going to give me more money based on my top line. So I'll compare on my top line. That's how it goes. That's a logic, isn't it? I hope, Harish, your earlier question, I've tried to reply. And if it is not, then still try to reply. Now, let's go to the next level. If I have this company and I want to sell, what is the time I should decide to go? Now there are every company as an owner, you understand about your company, when is it is at a high growth, what is the time it is at maturity, when it is going to get saturated. Now, if I'm at maturity level, if I make a discounted cash flow, I can very well say there's still growing period. I can show very well my discounted cash flow. I can make money. But if I'm selling at saturated level, my business has not grown for last 2 years, 3 years, I cannot make my extraordinary valuations by showing increase in sales. Of course, those valuations, those assumptions of increase in sales are tested. And I sit on behalf of my investors to test those assumptions and see how does the valuation work. So that's how we check this. So what is the best time to sell the company? It's extremely important for you to, sorry, I'll just go back. Very important for you to understand this. So it depends. High growth companies are the one which are here. These are generally at the startup level when your people are at young level or you have some very niche product and that product starts getting matured and then it gets saturated. So generally each one of you should know if I'm at maturity level, if I get an investor on board, I can get more money. I can at least get money for the past efforts, for the goodwill I created, and then either some portion of it can go inside the business, and I can stress this maturity further up because I'm getting extra funds inside the company as well as for myself, and I can take company still to the next level. This period of maturity can get stretched for longer period. Of course, there are times if you stop investing in company, if you stop in putting additional effort, if you stop investing in research, your maturity will come very early. Need not be maturity, it can be disaster, isn't it? So this is how it works. So it's very important for us to focus during this period. If you guys think, since you know your business, if you have reached to this level, then you should take a call. Is this the time I should get somebody on the board? I should get some investment for myself, or should I get some additional money inside the company and again put my throttles to the next level? Can I take my company to the next level? It's very important for us to understand. So these are the three situations in which we do it. What we do it in startups, we buy companies in high growth. In fact, startup could be a good option for you guys to evaluate based on what I'm discussing today. Why don't you think of acquiring a startup and putting it in your company, which will take your company, existing company, to the next level? Of course, you have to understand, you have wisdom of handling your product, knowing your customers successfully, being a dealer. So this can help. So this can be a very well option. You can use it. So I'm not explaining this how the beta factor works. Beta factors mean sensitivity of market to the view of value. I'm not taking this. Was not my planned discussion. This is how these discounted cash flow figures, they look at it. We use EBITDA as a basis. We use cash flows as a basis. So what we try to do in discounted cash flow is, what we do is in discounted cash flow, what is the cash which is available to the owner that is accumulated over the period of time, that is discounted. And from that, we reduce the debts, and then we say enterprise value is XYZ. And a lot of time, these ranges you can see, what if it does a growth of 17%, 16% with the profit range of 4%, 5%. These combinations, we use it to arrive at some range of figures. Now, if I have to take this range here, the worst and the best range I can variable derive from this. I can take this average, provided I test each of these figures, each of these assumptions before I agree on these figures. Being owner, I'm not expecting you to dive there, but it can help. This is how these discounted cash flows, they look like. So each year's future discounted money is taken here, and then we have a discount. Discount figure is determined based on what is the cost of capital. Based on that, we do it, and the entire value, then there's a terminal value. And also your share, since it is not being listed, we also do it. These are assumptions in future. If you guys, assuming your sales are going to go up, how these are going to go up, what are the expected additional costs, all these assumptions are tested. If I'm assuming you're going to say my business today is 50 crores, in next 3 years, I want to do 500 crores. I want to see the reasons. I want to understand what is your assumption. I want to understand from where will you get money? Where will you get additional clients? Where will you get, what will you sell, which you have been selling only 50 crores in last so many years? So all those factors are evaluated. That's called assumption evaluation. That's how we evaluate assumptions. And each one of you should have those assumptions clearly defined. You being a business owner, you know how to derive. You can very well do your own budgeting for next futures. So I just want you to just touch upon one small. Budgeting has become outdated now. There's a concept called annual operating plan. You should do strategic planning for your company, which should define how do you determine your sales, how do you determine your resources, how you're going to actually achieve each. So that gives guidelines to each of your department. In each of department, what they are expected to do next year is defined. That's called strategic plan, which we also call it an annual operating plan, which is an advanced version of budgeting. So each one, if you can use this for doing your own business, you can actually budget this out. You can actually see these models, and you can very well compare yourself. Where do we stand? What we plan? Okay, these sheets, since you have assumption, will also help you to identify what, why, what are the reasons I'm not able to achieve. Last year, I assumed I'll increase it by adding more dealers inside. Didn't happen. Why dealers didn't happen? So what each dealer costed? Okay, why current dealers didn't increase their sales? Last year, I was assuming X plus Y. It didn't happen. Why it didn't happen? So at least you know reason where to identify these challenges and where to address it. So these annual operating plans are very advanced plans. They'll also help you to work on your these discounted cash flow. So if you guys are working on budgeting, request all of you to start working on annual operating plan, which are strategic. The amount of time what you spend in making budget might be half the what you do it in annual operating plan. But annual operating plan will give you very detailed insight about your company. You can very well move with this. So I just wanted to share this. Vinod Sab, how long I can, what is the time I have?
I think we have already overshot by 10 minutes.
Okay, so what I'll do is, I'll take quickly, give me only 10 minutes. I'll take you through, I'll not explain Zomato. Okay, I'll take 2 minutes on Zomato and I'll explain you about listing options.
Okay.
Yeah.
Okay.
Okay.
Yeah.
Now, each one of you to understand how did these companies get value, suddenly a decent value, whereas they don't generate, they survive on negative cash flows. And each of the deliveries don't contribute positively, they contribute negatively. How do these do it? So again, I told you before, what you have to understand is what is intellectual property sitting inside. In Zomato, they had the year in which they went for public listing, they had 3 crores live customers. 3 crores live customer, and that out of 3 crores each year, each month, they had 1 crore plus customers placing order actively. So if somebody has to, a company from the overseas wants to push his product through Zomato, they'll certainly value. See, if you remember, Flipkart in India was making losses. Why did Amazon invest in India? Because they were looking for a market share in India. They know how to make money by selling their product. So they are not very keen. So what they invested in Flipkart is a cost of getting that market network, access to the network. That's how it works. So this is just a short I wanted to share with you. Since I have less time, I'll just take you through quickly valuation, public listing, and then again. So I'll not take much of a time, but I want you to understand. Are you able to see my screen? Just hold on.
Yes, yes.
Yes, yes, yes.
We see your folders.
Oh no, sorry, just hold on. Stop sharing.
Stop. Screen. Okay, share. Screen.
Okay.
Screen.
Yeah, fine. Is it visible?
Yes. Yes.
Yes, yes, yes.
So okay, I'll just take you. I'll just take you through quick on. So there's always been a debate. All of you, we can discuss separately what is good for me, whether I go to public listing or what if I go to private equity. Each one of you understand do's and don'ts of both. You also have to understand what does private equity means to us and what does public listing means to us. It's important for you to understand. This is my disclaimer, and I want you to spend time with me in case if you have time, or we can have some other session on this. I'll not take much, but I'll tell you what is a common we find challenges. Just hold on, I'll just open the sheet. So what are the common fears among the SME owners? We all feel market is not the it's not the right time to enter market. Abhi nahi bhai, baad mein enter karna hai. Current valuations are cheap. We expect our expectation is always very high, no matter how a company performs. Some of clients say, no, mera books of accounts theek nahi hai, I'll have to still work on it because they're not focusing on the books of accounts. Lack of competent manpower. Some people say, mera paas team theek nahi hai, I need to have a team. So these are regular reasons, regulatory intervention. Somebody feels, if I go to public listing, there's a SEBI, there are other government departments, they want to watch, they want to see my financial statements on monthly basis, quarterly basis, half yearly basis. So my information is on public domain. People will understand more about me. And also if I'm listed, anybody can buy my company if they buy my shares. So these are general common thoughts. People have it, but I want to tell you this is not how it is worked. How it helps is it helps you to first, very important, is retain your talent. If you have companies like ESOP, what will people do with ESOP if it is not a listed company, unless in that case owner has to give buyback, or if it is a listed company, people can very well make money. You remember in Infosys, one of the first earlier companies in India which did ESOP, and a lot of their junior employees, when they retired, they make huge money by selling their shares. That's how it helps. It certainly helps. It helps you to improve your debt equity ratio. Your debt goes down. You're investing, getting more equity into the company. So that's how it helps. There's no moratorium period because there's no loan. You have a better bargaining power because you're a listed company. You're sitting on with a decent level of cash to take certain projects. Good corporate governance. Companies are expected to maintain decent corporate governance. A lot of you already have corporate governance. If you already have, so that means you guys are ready. What does corporate governance mean? You need to understand. You need to basically, it's nothing but you need to follow rules and regulation more transparently. At the same time, you should be able to demonstrate what I've followed. I've done it. That's how it works. Credibility among stakeholders, yes. If your stakeholders could be bankers, government, you're seen, perceived differently. If you're a listed company, people, visibility in industry, you're respected. If one of you is listed in Infotech Software Dealers Association, you are seen by people very differently. Understand that. So unlike your company has worked for 18 years, 10 years, 15 years. What is the value it has created? It is not a value which is sitting in balance sheet. That value, what it has created, is a valuation which is never get unlocked throughout your life. If you're not unlocking it, what is the value of creating it? That's how it is seen. So in the IPO can help you to do that. Of course, a value wealth creation is important, both to the shareholders, for my people who have invested. My own investment goes up. My investment, if I'm not listed, is own investment value, which appears only in balance sheet. It doesn't go beyond that. Tell you listing, if you're a SME listing, any company can go for listing. I don't see any big challenge as long as they follow certain rules. As long as your net worth are positive. I know being a retailer, software infotech dealers, you have your net worth positive. It says you should have at least 1 crore positive net worth in last 2 years. That's fine. Post paid up share capital is not more than 25 crores. If you're going for SME listing after issue of capital, the total shares what I issue should not exceed 25 crores. That's how it says. Net tangible assets is 3 crores. That means if you remove intellectual property, your asset should be 3 years. 3 years track record. 3 years. How do I compare 3 years track record? So, 1 saal pehle I was a proprietorship. I was a partnership. They are ready to even count that. So they gone to that level. It will still be considered for 3 years track record, provided you have 1 year company's audit done. EBITDA should be positive. It says EBITDA out of 3 years, your EBITDA should be positive. Not a big deal. You guys know how to run your company. You can very well do it. You should not have any pending default, interest defaults, principal outstanding repayments in the company. So what you need to do is maximize max dilution. If you're going for SME listing, 25% is a dilution expected. People are scared, mera 25% business ka bahar jayega. But I've seen my client case, I've seen SME listing people who have diluted 25% initially. After they went for listing, next 2% diluted gave them more money than 25%. So that's how the value creation has gone up. It is many multiple fold times. I can share list of name of companies which are available on public domain. You guys can very well do it. There's an independent director you are expected to appoint. These are the people who are trying to get somebody who's matured. You have to appoint them, who can very well guide. In fact, it helps company as a third party. Independent directors are not anyway directly, indirectly connected to a company, should not be relative, should not have any investment or any financial relationship with the company. Increase in regulatory compliance for both. Yes, it has certain regulatory compliance. If you're getting these benefits of not paying anybody any interest and huge money, huge valuation, you should be ready for that. Corporate governance is, yes, you have to look into your corporate governance, automating your existing softwares, your process of delivery, receipt, everything has to be automated. It's good for you, isn't it? Are we doing anything more? These are all expected by company. You're also expected to understand the risk of market cap, how it impacts a company. That's all we generally do it. Otherwise, even if we are not listed, we still try to see how does it impact the market risk to me. And if financial statement do not have any mistake, or if they have any mistakes in past, like they do not have a PF, gratuity, ESIC, make sure that they provide it, recast your financial statement, represent it. See, this is how the auditors are expected to do it. And these are some agencies which are expected to appoint. I'll just take this one last. You are expected to appoint merchant bankers. They are the one who really help you to understand or educate you, help you in doing due diligence, help you in doing valuations. So merchant banker, depending on who's a merchant banker, really helps you to go for it. You have to convert your company into public company. I've already told you, appoint an independent director. Then you have to file an approval to SEBI. Of course, your merchant banker does it. The valuation of company is also done. That is where we also help company. And then after approval is done, we also take ROC approvals, and then we go for listing. Listing period is generally given between 3 to 8 days for listing. And once that is done, I want to see somebody from your end and to ringing this bell at stock exchange. Costs are, it takes 6 to 8 months if you start preparing with a good merchant banker, with a good team to do it. This is what has been my experience. Approximately cost 6 to 12%. I've seen in some cases, it's also has come down 4 to 6% as well, depending on size. If your size is very small, it goes up. Otherwise, cost, you can take 4 to 5, 6% average. You can, but if it is too small, then it goes up. Don't take that. So they have to provide financial half yearly, quarterly, annually, depending on, these are some additional compliances which you are expected to do it. For SME listing, you have to make your financial statement half yearly, and for larger, it is quarterly. And these are the agencies anyway you're dealing with income tax, anyway you're dealing with companies, you're already dealing with labor laws, you're already dealing with factory laws, specific laws, legal department. You already have FEMA in case if you have foreign exchange. Only what you're dealing is additional. It's the SEBI law, isn't it? As long as you understand your laws, you have a right team to handle it very well. You can do it. So what does this mean? Your compliance costs are going to go up a little bit. So when you evaluate your profits for future projection, you also have to take additional cost what you will be incurred for company. These are the agencies with whom you generally expected to deal: merchant bankers, credit rating agencies, monitoring agencies, statutory auditors. Your statutory auditor makes sure that they are required to be peer-reviewed auditor firm. They cannot be normal CA firm. So their audits are again audited by CA Institute. Legal advisors, registrar. There could be PR agency which is not appearing in this. Yes, you need sometime PR agencies. You need underwriters in the sense those are the brokers. In case if your shares doesn't get listed or doesn't get subscribed, they buy it. They charge commission between 2 to 5%. That's how it goes. Depository, share registrars and all. That's it. You guys can ask me question. I compress it as much as possible. Vinod sir, Prashant sir.
Yeah,
Yes.
actually, it was very, very insightful for me at least, and from my perspective, I would have preferred to listen to you more for the next hour also, without any challenge. But then I do understand from the greater community perspective, uh, the time is actually a constraint, could be a constraint, but I leave the house open for questions. Anybody who has
I
any
have a
questions?
comment, Prashant, rather than a question, if
Yes,
I'm
please.
allowed. So,
Yes,
Yes,
please.
please.
the reason we got a little rushed is because I think we are trying to mix two subjects into a single session.
Yeah. We should have done
Valuation is another matter, and SME listing may be a subject by itself. So,
Correct. You are
there
absolutely
are a lot
right
of people
in
interested.
your
That could be a
yes,
separate session only for the
yes.
SME listing, so that Ujwal can, take you through the process properly. I mean, he has a lot of inputs to give, but naturally, due to lack of time, he could not do as far as the IPO.
We'll probably invite him to a regular event where he can spend a lot of time, and he can something like do some sort of a workshop for us. Ujwal, do you undertake workshops?
Yeah, I don't mind, Chief. I recently I took CEO's Club in Mumbai. It was a marathon session for us. I could at least make sure that in the evening during drink, everybody was focusing on their balance sheets and the valuations. Everybody was so serious after discussion. I was so happy to see that. I'm very happy to get connected with such teams.
So you're good in changing perceptions of people.
I'll try my best. I'll try my best.
Okay. What typically is a good size for SME as IPO?
Size in the sense, small companies fine as long as these have basic conditions which I've indicated. You have positive net worth, you have EBITDA positive, you can very well do that. I mean, I've seen as company as small as 15-20 crores turnover has also gone to Bombay Stock Exchange.
Wow.
The cost look high because it didn't make. But today, when I look at the values, I'm so we're fortunate to see in an era in which we are all of us today. Each company which is listed today as SME has become huge in value, and 68% of SMEs are moving to the larger platform. That's an amazing to see. That's how people have changed. That's how people have corporatized their business. So this takes care of your succession planning as well in future. Who should be coming and taking your business? Who should run your business? Everything gets addressed when you get into these kind of modes.
Thank you.
Good evening,
Any more
Mr. Ujwala.
questions?
Yeah, good evening, Mr. Ujwala. This is Sanjay Srivastav here. Yeah, so turnover is not a barrier to do an SME listing, right?
That's right. Turnover is not a big barrier. Generally, dealers, certainly you guys will get qualified.
Okay. Okay. Then the risk factors in terms of clients we have, and then, you have 50% of business coming from 25 clients, and then rest of the business coming from 500 clients. Is that that could be a risk factor? So do we need to get that evaluated?
Yes, Sanjay, we do that. A lot of time when I do evaluation, what I see, even if my major component of reliance is on certain clients, what we see is how long I'm able to hold on to those relationships. And if I'm able to hold on those relationships for longer, then it's my asset. That's how I tell them. That's how it works. Although my reliance is high, it is certainly expected to leverage or to de-risk. We expect to have more, but more smaller customer also have a challenge depending on the way you handle volume. When you evaluate these, we can also see positive side of those challenges.
Okay, fine, great, fantastic presentation, sir.
Thank you, Chief.
So, if somebody, a member wants to reach out to you, how do they reach out to you, Ujwal?
I'll share my email and my mobile number. If you want, I can tell you my email number. I'll put it in chat box now. My email number is 98203 13352. 98203.
Please put it on chat, the email ID and the contact number.
Ujwala, and I'm putting my email ID ujwal.landge @
Not able to see. We're not able to see on the chat box.
Everyone, I'll just publish. It went to only Vinod Shah.
Yeah, it is good.
Yeah, it's all small, and then is my stuff.
600 के कॉन्फ़िग में वो करती है 3 इंस्टेंस ऐसा बोली और 246 रैम और 100 जीबी एसएसडी लेता उसमें वो 3 इंस्टेंस बनाती है तो मैं शूट करने वाला मोबाइल नंबर
You can very well reach out to me. Whatever best I can help you, I can certainly will do it.
Where are you based out, Mr. Ujwal?
My office is at Vashi, Navi Mumbai. We also have office at Panvel, whereas my teams work in Pune. We have it in Bangalore. My team works at Dehradun. So mostly my office is at Mumbai. So we work in and around Mumbai more closely. But whereas we have clients, we go to their places and we work from there as well.
Okay.
We are 200 employee based firm, and we are 45-year-old firm, 12 partners. Each partner handles different verticals, and we have internal around 68 people work in GST, almost 45-50 people work in tax. We handle including litigation. We are peer-reviewed firm, handle audit for a lot of listed companies as well.
Okay. Okay. And there is something like an initial fee which starts off, or how do you start with?
It depends purely the business and what exactly you're looking for service. I'll explain the whole range of service, what is required for your company. We also perform one-day health check to our client before we give any quote to identify what we can offer, what is the best. And of course, there's a detailed discussion, and we can take a call on each scope, timelines, who's involved from my side, activities. You can also talk to my team members so that you can get a first-hand information how it works.
Okay, thank you. Thank you.
I guess we can close. Yeah.
If anybody has any more questions.
Ujwalji, what is the total cost of one IPO for listing IPO? What is the total cost?
That depends on 4 to 6%, 8%. But if you are going for you can as a thumb rule take around 5% approximately cost for you initially.
If I
less than 50 crores or less than 50 crores, then it will be 6-7%. That's how you can take it.
Oh, this is the merchant banker fees, or this is total cost?
Total cost including PR, merchant banker, the stock exchange listing fees, overall fees.
Or what is the paid-up capital requirement for the SME IPO? minimum.
Say it again.
What is the paid-up capital requirement for the minimum paid-up capital requirement?
So you can start with your existing paid-up capital of company.
Suppose that my paid-up capital is 1 crore rupees. Then I can get IPO?
Yes, certainly you can go. I don't see any restriction.
Okay, 1 crore.
And what is important for you is 1 crore is what you are expected to dilute is 25% of it. So you have to assume your 1.1 crore is 75%. That means you can issue up to shares 33 lakhs ka shares you can issue further.
Okay. So are you you are the merchant banker, or you are the advisor?
I'm an advisor. I become a part of company's team and help company to work with merchant bankers, because you need, as a owners, you need somebody who can evaluate with you from your angle, who's not connected based on the percentage of success fees. So I'm not pushing you to achieve something and make. So we work purely on our advisory based on time what we spend, and not on that. And we become your team who can evaluate with you, openly discuss, and then talk to merchant banker as a one team and do it.
Okay, with you. Any recommendation for merchant banker? You have some name for SME IPO?
We can share it. Depending on the industry, we can certainly share it.
Okay. Thank you.
Thank you, sir.
So, Ujwal, I have a question. Would you also be able to help in case somebody is looking for an independent director as per the regulators? I'm sure there is a panel wherein there are independent directors. You need to pass an exam for that.
Yeah, I can help, but I want to be very specific. When I want to hire somebody, I want to make sure the value of my company goes little up because I'm hiring somebody. That is,
absolutely.
I try to keep in mind. That's how we generally function. So we look for somebody with certain background when we take somebody as a, that helps me then getting somebody on the without a track.
Yes, sure. Thank you.
Thank you, Chief.
Anybody else has any questions? I believe, Vinodji, you can close the session now.
Yeah.
Thank you, everyone.
Thank you, sir.
Thanks, Ujwal. It was a very nice session. I think
Ujwal,
maybe
you
now.
can look at the chat box also. There are so many congratulatory messages for you.
Thank you, sir. Thank you. Thank you for appreciating it, sir. Thank you. It's
And
good encouragement for me, sir.
And I think we should have a part 2 maybe sometime later.
I'll be very happy. Give me more time, but next time.
Yeah. Thank you so much, Ujwal. Thank you.
Vinodji, can I say something?
Yeah.
Yes, Lalit.
Ujwal bhai, we are I am the part of ISODA.
Okay, sir.
I am the member of ISODA. Recently, I opened my company as a merchant banker, name of Cretex Corporate Services Limited.
Okay.
We are the all India, we are the top 5 company in merchant banking and SME IPO.
Very nice.
So we can discuss also about this ISODA platform. Together we can say many things. We can provide many information other than you are providing.
Thank you, sir. Happy to work with
your session is excellent and your information is always right. But many small things is very need to any ISODA members requirement. So then we can. I am also sitting in Bombay in BKC1.
Okay.
So usually we also meet and we are discuss about SME IPO. We are the merchant banker. As the name of Cretex Corporate Services.
Greatest corporation. I've made a note of it.
We are the A category. We are the BSc listed company. This is the BSc listed company.
Okay.
Or we are the A category merchant banker.
Fine, sir. Nice.
Okay, Vinodji, we discuss also about merchant banking, about SME IPO.
Sure.
So if any help from the SME IPO, we can also help to.
We'll organize a specific session with you, sir.
No problem, sir. No problem, Shantai.
Okay, thank you, everyone.
Thank you, Ujwalji.
Thank you so much. Thank you, everyone.
Thank you, everyone. Excellent session today. Thanks a lot.
Thank you, sir.
Thank you, ISODA board.
Thank you.